you a federal employee, CSRS or FERS? Hello, I'm John Mason, President and Certified Financial Planner at Mason & Associates. I personally have been specializing with federal employees since 2010, and our firm owners, Mike and Ken Mason, have been doing it since the early 90s. Collectively, our group of advisors has over 100 years of experience, most of that serving federal employees. And in today's video, we want to show you an initial look to see whether or not you're on track for retirement. We started this, Mike and Ken developed this kind of quick gut check a few years back, and we call it Modified Current Income, or MCI for short. So before I show you how to calculate your specific modified current income, so you can do this quick 30,000 foot view to see whether or not you're on track for your retirement, I want to point out that financial planning is a lot more complicated than what I'm just about to show you. This is going to be a 30,000 foot flyover to see, are we on track for retirement? It doesn't talk about insurance, estate planning, tax planning, 30-year tax strategy, annual tax planning adjustments, how to update your beneficiaries to coordinate with your estate plan, and more. So there's a lot more to specific financial planning than can I retire? But many of you are watching this video because you want to know initially, can I do it? And then after we determine if you can, through this process and a little bit more analysis, then we want to determine, well, now that I know I can retire, what could retirement actually look like? Meaning, do I have to live on the same level of income that I had yesterday, or can I live on more? Can I live on the same income I had yesterday, or do I have to live on less? So a lot goes into this, but I'm going to show you today our modified current income approach. Remember, it's our 30,000 foot view. We're financial planners first, we do this second. So what I'm going to show you today cannot be construed as financial planning, tax planning, or any other legal advice. If you want actual advice, you have to be a client of Mason & Associates. So let's dive right in to our modified current income calculation. Now, this is an Excel spreadsheet, and I will try my best to highlight the assumptions that we're using as we move throughout the spreadsheet here. So in the top few cells, you're going to have what we call modified current income. So the whole idea behind modified current income is, let's say you're a federal employee and you make $100,000 per year current salary. So how much do I need to replace in retirement so that you can walk into retirement without breaking stride? Meaning, we need to replace this amount of money in retirement so you don't have a decrease in your lifestyle. Many of you have maybe heard we need to replace 50% of our income, 60%, 70%. Well, if I'm a federal employee and I'm getting ready to retire and somebody tells me that I'm going to have a 70% income replacement in retirement, that does not give me a lot of confidence. What if we could replace 100% of your modified current income? So here's how we define modified current income at Mason & Associates. Take the income you have today and start subtracting off the bills you have today that you won't have tomorrow. So in the example that I'm showing you on the screen here, we have a $100,000 federal employee who's around 65 years old. They'll be retiring at age 67, which is going to be their full retirement age for Social Security. We assume roughly a 10% contribution into Social Security and CSRS. Folks, Social Security costs 6.2, FERS cost 0.8, so collectively that's 7%, but you're also having to pay taxes on that income to pay your 7%. So we subtract 10% right off the bat, meaning that $10,000, you've never spent it, you've never been able to enjoy it, that's not income we need to replace in retirement. Secondly, we subtracted off here thrift savings plan. And we assume that in this example, the federal employee is contributing $10,000 a year to TSP. So we arrive at an $80,000 modified current income. So on a high level, if we have $80,000 of income in retirement and we have $80,000 of modified current income today, we would think, at least initially, that we're going to be able to retire on the same lifestyle that we had before. So we can't take this to the bank. We can't say that this is always the case, but generally speaking, this is a good 30,000 foot review of your existing retirement scenario. What other things could we subtract off to arrive at your modified current income? Maybe you're paying for kids to go to college. Maybe your mortgage is about to be paid off. Maybe you've been carrying very expensive Federal Employees Group Life Option B, and hopefully you worked with a qualified financial planner to determine whether or not you needed it. If those are premiums you don't have to pay anymore, that would subtract off to arrive at your modified current income. So again, in our example today, we're going to use $80,000. And remember, I'm looking at somebody who's about 65 years old. I know we're well past your minimum retirement age under FERS, but I'll show you why I use this example, and then we'll talk a little bit more through it as we keep moving on. So now, what's my income replacement if I'm a federal employee at age 67 with 30 years of service? Well, number one, I have to calculate my FERS pension. Years of service times 1% times the 1.1 multiplier is going to help me arrive at that pension and retirement. So in this example, because I'm over age 62, instead of getting $30,000 a year, that would be my standard 1%, we're actually going to get $33,000 per year. And this is before survivor benefits as well. We're actually going to receive $33,000 because every year is going to count for 1.1%, not the 1. The way you get there is you have to have 20 years of service and be over age 62 when you retire. That's going to get you the 1.1%. And I guess I should say you have to be 62 when you retire, not necessarily over. So in this example, our federal employee under FERS, 1.1%, $33,000 a year income replacement. I used the Social Security quick calculator over here on this screen, and I assumed $100,000 retiring in the next couple of years. And the Social Security quick calculator indicated that this federal employee should receive about $30,000 a year in Social Security benefits. Again, that's starting at full retirement age. Should we start at 62? Well, not if we're still working, probably. Should we always delay till 67 or 70? That's a different story. In this example, we're showing 67. And then finally, $500,000 in TSP at retirement, and we're going to assume a 4% distribution rate. So on that 4% distribution rate, folks, that's going to be $20,000 a year of income replacement. So don't hold me to 4% is the magic number. I'm not saying it is. I'm not saying you should take that more or less. I'm just using it for an illustration. At 4%, that's $20,000 a year of income replacement. So what have we found? 33,000 FERS, 30,000 Social Security, and 20,000 TSP. And our example totals almost $84,000 of income replacement, which is more than your modified current income. So folks, this is an initial way to kind of gut check your financial plan. Am I on track for retirement? Am I not on track for retirement? And we call that modified current income. So now that we've reviewed modified current income, I want to leave you with a few closing thoughts. Retirement is a lot more complicated than a few cells on an Excel spreadsheet. There's a lot more that goes into your individual financial plan. Whether you're married, whether you've been divorced, what your goals are, how old your children are, your legacy, the lifestyle that you desire. So much more goes into the retirement planning scenario other than can I retire and what's my income replacement. So modified current income, you can use that as a tool to give you that gut check. Here are some things that we need to think about though. Many of you may be thinking, I can't believe John only showed a 500,000 TSP. That was on purpose. I'm showing that because that got us home. And that got us home because we worked until 67 and we didn't take a 25 or 30% reduction on our Social Security benefit. What if I'm the federal employee who wants to retire at minimum retirement age, who's taking now a FERS annuity supplement, who loses those years of earnings, who then activates Social Security benefits at 62? Well, all of a sudden the calculation is much different for them. Now all of a sudden TSP is a lot more important than it was before. What if you have a highly compensated spouse who has never saved into their retirement or doesn't have a pension? Well, not only are we replacing your income, we have to replace your spouse's income. So now all of a sudden your thrift savings plan is more important. So modified current income, use it as a tool to help you kind of plan for what retirement looks like. And if you want real financial planning, that's where you need to hire a certified financial planner or a team of professionals that speak your language, not theirs, that can help you understand and solve the specific problems that you have as a federal employee. We do that. We're financial planners first. We do this content creation second. We'd love to work with you. But if you don't want to work with us, there's other firms out there too that specialize with federal employees who can help you through this retirement journey. We're honored if you choose us. If not, keep checking out more of our content that we're doing on this YouTube channel, as well as our Federal Employee Financial Planning Podcast. Take care.